Hello and welcome to Commodity Champions. I'm Manisha Gupta, and the oil markets continue to see volatility as macro factors push prices either ways, seemingly by the hour. The revival of the 2015 nuclear deal has been subduing prices, as a revival in the deal will lead to a rise in supply. However, warnings of an output cut by OPEC and allies nations to control the fall sent prices higher. Despite this, a cut in Chinese demand weighs on a long-term outlook for prices. The world's #1 oil importer continues to be plagued with a heat wave, forest fires and political tensions with Taiwan, which ensures to keep demand lower. So what lies ahead for the oil market amidst all this turmoil? Joining me to take that discussion forward is Ole Hansen, the head of commodity strategy at Rabobank. Ole, hi, always a pleasure having you. And what a volatile week this continues to be, where we are looking at the crude oil prices trying to swing on both sides of $90 per barrel. But first up, how are you reading these statements from the OPEC Secretary General and then the Saudi Arabian minister about cutting supplies going forward?
Well, good afternoon. I think what we saw yesterday in that comment from Saudi Arabia is really what we have been seeing in the market as well for a while. That there is a certain disconnect between the futures market, the so-called paper market, and the underlying physical market. Just take a look recently at the renewed rally in diesel margins, simply because demand for refined products are strong because gas prices are as elevated as they are around the world. So we have a futures market where macro-orientated traders are selling oil as a hedge against an economic slowdown, but at the same time it just doesn't add up with the underlying developments that we're seeing in the market. So I believe that we're pretty close to a low point here in the oil market, and I can also I see the reason why the Saudi comment came yesterday, and it just highlighting also a market maybe a little bit troubled by low liquidity and a lot of participants not as active as they have been.
All with the kind of profit taking that we have seen in most part of August, where 90 seems to be the new 100 now, what is your sense on where are we headed in sense of price? I mean, are you working with a range right now?
Well, as long as the recessionary threat remains as real as it potentially could be, especially in places like Europe, then that will have a negative impact on price action. But if the underlying fundamentals continue to point to reasonable strength in demand, or at least not a slowdown in demand, then eventually prices will reassert themselves, and then we're left with a speculative interest, which is the lowest in more than 2 years, lowest since April 2020. And that could potentially trigger a rebound. So for our quarterly outlook that was out obviously a little while back, we were looking for a 95 to 115 range. We hold on to that, but at this moment it looks like it's more 95 to 105 range. But I think we are at or near the low point in oil here.
All right. That being said, how are you looking at the gas prices? Because that has been another animal in itself. And I mean, a 15 to 20% of a move on a daily basis is something that you've learned to live with right now. But with what's happening between Russia and Europe, what is your sense? How much higher are we headed from here?
Well, it really all depends on the supply security heading into the autumn months. We're only a month away now from the winter demand season starting in Europe, and markets have been caught out by the worries about the renewed maintenance on the Nord Stream 1 gas line, which is going to be out of action for 3 days. The market clearly worries that the supplies will not come back next week when that maintenance is over. And at the same time, very low water levels on the River Rhine this summer, which has reduced the ability to move gasoline, diesel and coal to utilities. So that's all putting upward prices. I think what we're seeing right now is a level that is so high that industries have stopped forward hedging their gas needs, simply because this price is not economical viable. So unfortunately, we're looking into an autumn where we'll either see demand destruction through industries turning down their demand, or the potential or the hopeful solution that we're going to see lower prices at some point.
I mean, as you mentioned, there are drought concerns, situations in China and in many parts of Europe as well. Power rationing seems to be like the common buzzword right now. And then the gas availability is the third point here. So at almost nudging $10 per MMBTU for the US gas prices, how much higher do we still have?
Well, in the US, US price is obviously $10, as you mentioned. If we look at the equivalent price in Europe, we are looking at $80. So we are trading 8 times higher in Europe right now. $10 gas in the US potentially could be even more over the coming months. Inventory levels are relatively low compared to where they would like to see them. We still have Freeport LNG export plant about to resume exports within the next month or so. That would also reduce the availability of gas in the US. So we're just simply looking into a winter where energy prices will be high. It will be challenging the central bank's ability to bring down inflation to levels that at least the market right now is pricing in. And that's also one of the reasons why we still favor the commodity as a sector, as a hedge, and also looking at something like the gold prices, which have come down quite a bit as well recently.
Oh, well, yes. I will talk to you about gold, but I still have one question on gas. And this is, we still have a hurricane season pending. And from 5th of December, European Union has put out a sanction on Russia that they would put in. And then everybody's talking about a harsh winter going forward. They are still recovering from heat waves, as we've seen in Europe, and higher than normal temperatures in US and etc. So as we head towards the last part of this year, what can be expected from gas prices?
High prices, unfortunately. Hopefully not as high as they are right now, because we have to remember that we've seen almost a doubling in the price over the past month. And some of the reason why we saw that doubling, they may start to ease somewhat, but still punitively high prices, forcing some kind of demand destruction, and with that obviously lower growth, and with that also the weakness that we're currently seeing in the euro against the dollar.
You mentioned about gold, and I'll come to that. And the gold prices have been a bit of a disappointment. I mean, we've seen nearly 5% negative right now in the dollar terms for the year until now. On one side, yes, there are recession fears and there is a war raging, but on the other side, you have the strong dollar index and the rate hikes as well. So would you say that all the factors really seem to be negating themselves, and that is putting pressure?
Well, it's a little bit controversial, I think, sometimes to say, but I think actually gold has done brilliantly. I think it's done what it's supposed to be doing this year. Yes, in dollar terms, it's down, but almost in any other currency, it's up on the year. And just look at gold as a part of a portfolio in order to just to mitigate risks elsewhere. We got the bond ETFs sharply lower. We got the stock market sharply lower this year. So if you as an investor bought into gold at the beginning of the year, even if you're dollar-based, I'm sure you're very happy with a 5% loss compared to 15, 20, 25% loss in the bond and the stock market. And also we have to consider that we have gone through the biggest jump in real yields since 2013 this year, and we've seen probably one of the biggest annual increase in the dollar also in a number of years. So against all these very, very strong headwinds, gold is only down small in the year, and it's up quite a bit across in other currencies. So I still like gold. I still like I don't like the inflation, but I worry that inflation is not going to come down at the speed that the market is pricing it. And when that starts to be realized in the market, that will add a new dimension to gold. Also on top of that, adding the physical demand from China and India, which has actually been reasonably strong in the past couple of months after the price came down.
Ole, how are you looking at the metal prices? Because even as China has been cutting interest rates while all other countries are increasing interest rates, but the quantum really is too small for the markets to start moving.
Metals are in a holding position here. But what we also have to remember there is that it's not only about demand when it comes to commodities. Supply is equally important. It is a market that needs to balance on a daily basis. And with the gas prices, again, returning to those levels, we've seen this, as you mentioned as well, smelters reducing capacity in Europe. That obviously reducing the supply side, and that's alleviating some of the potential worries about demand, at least here in the short term. We got a congress in China later this autumn, and I'm a firm believer that they will have to do something to mitigate some of the economic risks they're seeing right now, especially within the commodity sector, in order just to maintain social stability, which is the key essence for the government. So with that in mind, metals are not going to have a great upward scenario, at least in the short term. But from a longer term perspective, I like metals. I like industrial metals. I like the miners. I think looking into the future, the demand will only continue to remain robust, and supply will potentially be increasingly challenged.
All right, so short term, not so great for the metal prices, but a longer term, yes, the demand will come back. So will the energy transition and all those things that the world has been talking about. But just for the near term, there are way more concerns. Well, as always, thank you so much for joining us and making sense of that volatility that we have seen in many of those commodities. On that note, we will head for a short break. But coming up, a discussion with Michael Rienzo, Executive Director at the Silver Institute, on the rise in demand for silver. Stay tuned on the other side.